Welcome to this roundtable on smart beta and factor investing. These traditional factors, value, size, momentum, low volatility income, is where we've been. But we're now you're putting your new factors in. What's the driver? What's so positive about that?
I think the whole purpose of factor investing is diversification. So we know that for a long time, investors looked at sectors or countries to diversify the portfolio. We believe that factor provides a better, I would say, framework for diversifying the portfolio, which will navigate the equity market over time.
I think when we look at the two most successful pieces of smart beta, or the ones that have attracted the most assets, we see that both sides, both risk and risk reduction and return enhancement, are the two pieces that have caught investors' imagination.
It's not the question of finding new factors or relying on old factors. It's more the way to build robust factors so that we are better equipped to navigate future times in the equity markets.
We talked about sort of factor investing and risk-efficient solutions. What do you think the difference are between the two?
If we refer to risk efficient as building portfolios that are inherently biased towards less volatile stocks, they provide defensive exposures and perhaps capture a low volatility anomaly. So I would call that one subsector of factor investing and perhaps one leg of a well-diversified multiple factor portfolio.
The value proposition is very different because in risk-efficient solutions, so if, for example, we refer to minimum variance, so it's a way to be fully exposed to equities, but with the objective to eliminate the risks that are going to cost in terms of performance. And those strategies became very popular after 2008, especially for pension funds and insurance.
I think the word risk is getting thrown around a lot here, and I think that...
Define what that is.
So I think we have to be very careful when we're talking about what is a risk to an investor, and I think you're being very clear, risk is the volatility and the downside risk of the portfolio, but that underperformance of the benchmark is also a risk that needs to be addressed, and it depends what benchmark they are choosing.
I agree that the risk definition is a bit unique. It depends on each client, actually. It can be a relative risk to the benchmark, but it can be also relative to the liabilities. If you are a pension fund, maybe the risk is to be underfunded. And as an asset manager, we need to provide the good solution to address these needs.